Hello traders, Steve Gans here. Okay, so here we are, part 2. Now, you've already seen the entire diagram. Part 1, I dealt with this stage right here, the getting into the stock, getting assigned the stock, and understanding what this process is of essentially selling a put, waiting for that stock at expiration to be below that strike price. And then, of course, I have to buy the stock at that strike price. I am going to have to buy 100 shares of it. So I need to make sure that I've got that powder dry. I've got that money set aside in my account. If I am selling this put on a, $50 stock, for example, and I'm going to have to buy 100 of them, I got to make sure that I have $5,000 set aside for when this gets put to me. Now, I may go through this cycle 3, 4, 5, or more times before I ever get the stock assigned to me. And each time as I go through this, I'm selling this put for a certain amount. Maybe it's $1, maybe it's $2, maybe it's $5, whatever. And so I could be picking up a fair amount of income off of this process until it finally gets assigned to me. Then once it gets assigned to me, I decide a price I'm willing to sell it at, and then I start selling the calls. So again, let's just say that XYZ stock is trading at $48.50. I am in the stock now because remember, I got it assigned to me over here at $49, and the stock's currently trading at $48.50. I go out, I sell the $50 call for $1. So that picked me up right there, picked me up $100. Maybe I do that process here a couple more times. So I'm selling that call, stock expires below my strike price. I just keep going in this circle here, selling those calls until it finally gets called away from me. So let's just say the stock moved up to $50.50. So my stock, I was forced to sell it at that point. I had an obligation to sell it to someone at $50. So I did that. But again, because I had these 3 times that I was able to sell those calls, this is called a covered call, by the way. When I sell those calls, I picked up $300 or $3 per share. Remember, I went through the cycle 3 times on entry as well. So my cost basis in this stock was $43. That's the $50 it was assigned to me at, the $49 it was assigned to me at, minus the $3 that I sold to get into the puts, then the $3 of the calls I sold. That gives me a cost basis of $43. Remember, it was just called away from me at $50. So at the start of this example, when I was selling puts to get into this, the stock was trading at $50. I'm assuming now that I sold that stock at $50, and again, cost basis $43, I made $6. I made $600 in profit on a stock that was the exact same price at the start as it was at the end. Now, this is the power, if you will, of going through the wheel process. The 2 mechanisms you're using here is in part 1, we're using cash secured puts to get into the position. Then after we're in the position, we are using covered calls to get out of the position. These are all things that can be done in an IRA. They're things that I would urge anyone to understand and make sure that they know how all of this works. And the same thing goes here, just to show you how this works in OptionStrat. After I am in the stock, I would come in here. I'm not selling a put in this particular case. I am selling a call. And maybe I sell the call. Let's remove this put here. So maybe I sell the call, if we're trading currently at $68, maybe I sell the call at $70. So I sell this call at $70, and again, I am bringing in this particular case, I'd be bringing in only 67 cents. So maybe I want to move that a little closer, and I'm going to bring in a little more money here. I'll bring in $1.07. Now, at this point, I would also own 100 shares of that stock, remember. So let me just add 100 shares of PayPal into here. This is what our payoff diagram looks like when I own 100 shares of PayPal. Now, I can, in fact, lose money on my shares. It's important to understand that. But if I was going to own those shares anyway, this is the key factor here, is if this was something that I was going to own anyway, I've made a commitment, this is a position I want to own long term, I already have that risk. Let me just remove this covered call from the picture here. This is my risk diagram, if you will, if I just own those shares. If the stock goes down, I am going to lose money, whether I'm doing this wheel process or not. What the wheel does for me is right now, if we drop from 68.80 we're at, down to 67.80, if I have only the stock, I'm down $100. If I sell this call against that, and again, I do this over and over, now we're down to 68, let's see, I went down to 68.80 it was, I believe, somewhere down in here. I'm actually up money still in this case at expiration of these options. So that's what it does in lowering the cost basis. That's my objective here, is lowering the cost basis as many times as I can. So selling as many puts as I can before I get into the position, selling as many calls as I can before I get out of the position. And I've put together a little calculator. Excuse me here, and sorry about the dinging. I had some trades going off, but this is a calculator that I put together, and let me just draw it down here. And this basically goes through the process for me. I put in a stock symbol, I put in my expiration date, I put in the option strike price that I want to sell, the price I'm going to get for that option, how many contracts of it I want. And this will go through and show me all of the calculations. Now, let me just show you one that, in fact, it was the one that just closed out here. I just did an earnings trade in PayPal in this particular example. My option expires May 3rd, so this Friday. My option strike price, I think, in PayPal was, let's see, PayPal is trading currently at 69. My put price in this, I believe I sold the 65s, and I sold them for about $2.20. So after I put all of that in there, and I did 2 contracts, we can see that my premium received was $440. I gained 3.5%. Now, this was an earnings trade, so I did this in this particular case. It was overnight. I sold these puts last night, and I was able to close them here this morning, getting 3.5% overnight. And in this particular case, this would give me an annualized return, assuming I could do this on a daily basis, which of course I'm not going to hit that record on a daily basis, but that would be a 319% annual return. So that's the benefit of doing these types of things. Now, the fact that I did this around earnings, it just sped up the process, if you will. PayPal was something I was willing to own. Again, I sold that 65 put. If this got put to me, I was going to start the wheel, and I was going to go and start selling calls against that position. So that's how that calculator works. What are the personal criteria I use for entering the wheel process? And I've mentioned some of these already. I know I want to own it. I know I'm willing to make a commitment to this stock or this ETF that I'm going to own at least 100 shares of it. Now, on many of these, I own 1,000 shares or something along those lines, so I might sell 10 puts. I don't want it to be too volatile. So while I do have some of these that I personally do in stocks like Nvidia, Microsoft, etc., you're better off at particularly starting with stocks that might be more stable. Stocks that are trading maybe sideways, maybe in a little bit of an uptrend. But again, those are going to be criteria for things that I'm going to want to own long term anyway. They need to be highly liquid, both the stock and the options need to be highly liquid. And many people will start this process and experiment with it the first time using ETFs. A couple of the reasons are you avoid earnings with ETFs. Sometimes stocks get volatile around their earnings reports. So doing this in an ETF, a lower priced ETF that is still liquid, is a good place to potentially start. What are some of the common mistakes that a newbie makes in this process? They think they're prepared to buy a stock, but then when it finally drops below their put price, all of a sudden they balk and they're like, oh my gosh, do I really want to buy this? This thing just dropped, okay? If you're convinced and if you've done your homework to know that you want to own a stock, you want that drop. If you didn't sell a put against it, you'd be waiting for a dip to buy the dip. So this kind of creates the dip for you, for lack of a better term. But again, some people sell that put and the stock drops and they start to panic. Oh my gosh, the stock's going down. I don't want to own it. So just make sure you do your homework. It's something that you're prepared to own. Some people do this and they start seeking high premiums. Premiums are a function of how volatile that stock is. So some people go into this and they pick a stock like an Nvidia or a Tesla or something because, wow, you can get monster high premiums. For selling a put on Tesla a few dollars below the market, you might get $18, $19, which is $1,900. But yet Tesla can blow way through your put price or way through your call price. I wouldn't just go out seeking high premiums unless you're the type of person that's comfortable actively trading and are willing to take big swings. People will panic out in big moves. So you sell a put, your stock drops 10%, you get it assigned to you. This goes to number one up here. Stick with it. If you knew you wanted to own that stock, you just got into it at a 10% discount, unless something has fundamentally changed about the stock. Then maybe you want to rethink the situation. And final thing is they don't understand how dividends might impact assignment. So this is a whole nother thing I'm not going to get into. You can certainly do this with dividend stocks, but dividends can sometimes impact when a person gets assigned, etc. Because if a dividend pays out during the time that you have one of your options positions open, that can impact the assignment price. So I recommend that people start this process for the first time on stocks that may not have dividends. And again, that's why you saw that I was doing PayPal. PayPal doesn't have dividends. I don't have to mess with dividends in that process. What are the downsides to doing this? You remember early on I said there is no downside risk. And this is the key part right here. Assuming this is a stock you want to own or plan to own as a long-term investment. So if the stock goes down, you're getting assigned at a lower price plus however many premiums you took in. That's a win, okay? If the stock goes sideways, well, you saw in my example of getting assigned at $49, selling the stock at $50, that the stock went sideways for a period of time, but I took in enough premium along the way, that was a win. The stock grinding up steadily. Yeah, I may sell puts. I have 2-3 months where those puts expire worthless. I get to keep that money. I finally get it assigned to me. The stock starts grinding up. It gets called away at a higher price. That's a win. So the one time when you won't lose, but it will be frustrating to be in a stock position where you have sold a call against that position is if the stock rips up massively. So to go back to my example that I just shared with you of getting put a $50 stock when it dropped to $49, and then I'm selling calls at $50, and then that stock goes to $60, okay, for some reason. Now I'm frustrated. I didn't lose money. I still made money by selling the put. I made money by selling the call. I made money by selling or letting my stock get called away at $50 when I only bought it for $49. Again, less all the premiums, which helped lower my cost basis. So it was a win. It was a winning trade for sure. But if that stock rips up to 60 and I have to sell it to someone at my $50 call strike price, I feel bad about that. It's dang, I missed out on a whole bunch of money there. Again, I want to stress, it was not a loser, but I didn't generate the same amount of income that I might generate in that scenario if I only held the stock and not sold calls against it. So that is the one downside to the wheel, and that's why I don't tend to do these in highly volatile stocks. If Tesla is trading at $200 and I sell a $210 call against my 100 shares and Tesla goes to $260, even though it was a winning trade, I'm going to be kicking myself a little bit in that scenario. So I want to look for things that are just slowly grinding up. That way I can just sell those calls against it day in, day out, go through this process over and over. At this point, let's start wheeling. Thanks so much, everyone. That wraps up the presentation on the wheel. Again, two parts, the entry part, selling those cash secured puts to get in, and then the distribution part, if you will, or the selling part, where after we own the stock, we're now selling calls, that's called a covered call strategy, to get out of that position at a later time. And the more cycles we go through, the more premium we take in before we get into the stock, or the more premium we take in before the stock gets called away from us, the better that overall trade is going to be. So that wraps up the wheel. Thank you very much for sticking with me. And if you like this content, please make sure that you like, subscribe, and give me a comment below. Thanks so much, everyone.